86% total returns, a 4.5% yield, but a massive 41% cut in its recent history. Is IQQA a hidden gem in the European market, or are you taking unnecessary risks with this ETF? Let's break it down. Welcome back, guys. I'm the Swedish dividend investor. So, for today, we're going to take a look at iShares Euro Dividend ETF, ticker IDVY or IQQA, not to be confused with QQIA. I haven't made a video about this ETF before, and it's not one I've seen mentioned a lot. So, here's what's coming. We will take a look at the following. What the ETF is all about. Size, fees, and current yield. Holdings, sectors, and country allocation. We will do a performance check. We will check the dividend history overview. We will do a dividend and yield on cost projection. And finally, we will do a valuation. As always, this is not financial advice. I'm just sharing my investment journey, my experiences, and my own analysis. Make sure to read the full disclaimer in the video description. Alright, the iShares Euro Dividend ETF seeks to track the Euro Stoxx Select Dividend 30 Index. The index tracks the 30 companies with the highest dividend yield from the Eurozone EU states. The ETF replicates the performance of the underlying index by full replication, meaning buying all the index constituents. The dividends in the ETF are distributed to the investors on a quarterly basis in March, June, September, and December. And like many UCITS ETFs, their biggest payment is in June. Their yield is usually somewhere between 4.2 to 6%, so quite the range. The fund size is 1.6 billion euros. The total expense ratio is 0.4%, and the fund is domiciled in Ireland. Let's head on over to BlackRock's homepage for IQQA. The top 10 holdings are the following: Randstad, Amro Bank, OMV, NN Group, ASR Nederland, Signify, Credit Agricole, BNP Paribas, ING Group, and Poste Italiane. For the sectors, we see a huge 53.91% allocation into financials. Yikes. Followed by industrials, utilities, consumer discretionary, communication, energy, consumer staples, healthcare, and cash or derivatives. Country allocation: Netherlands, France, Germany, Italy, Belgium, Spain, Austria, Finland, and Portugal. So a bit of a different mix from what we're used to. I just love seeing this. The PE ratio is 12.82 and their price book value ratio is 1.17. So going by book value, it's a bit overvalued. So let's see their performance, with dividends included, aka total returns. Their 3-year performance is 86.63%, 68.05% 5-year, and the max time frame is 198.29% since October 2005. Let's compare it to some other ETFs. I've gone for VDIV, Van Eck Morningstar Developed Market Dividend Leaders ETF, FEUI, Fidelity Europe Quality Income ETF, and the S&P 500. Year to date, we can see VDIV in the lead with 17.99%, IQQA at 16.27%, FEUI 14.25%, and S&P at 13.64%. 3-year, well, look at that. IQQA in the lead, 86.63%, VDIV 82.75%, S&P 65.18%, and FEUI at 53.95%. 5-year, VDIV with its massive 137.33%, S&P 87.59%, IQQA 68.05%, and FEUI at 46.75%. Let's do the max time frame as well. Since September 2019, VDIV 168.99%, S&P 165.6%, FEUI 88.09%, and IQQA 79.24%. So, it has been doing great in the later years, but not over a long time period. So, let's take a look at the dividend history. A quick break from our sponsor, you guys. Did you know an easy and free way to support the channel is to like, comment and subscribe? Why don't you try it out? Thanks. So, what do we have here? Shockingly,
I am shocked. Shocked. Well, not that shocked.
we see a huge dividend cut in 2020 of 41.67%, and people say covered call ETFs are risky. We do see the trend line is going up, but during 2025 we still haven't passed the 2019 dividend. That's pretty bad. They could be on track to do that. The first two dividend this year amounts to 0.76 euros, and in June last year it was 0.65 euros. I've calculated their yield using their 12-month dividend, and it is sitting at 4.49%. Their growth rates are the following: 3-year 4.08%, 5-year 10.35%, and 10-year 2.61%. That 10.35% is heavily skewed by the huge cut in 2020 and then high growth until 2023. I don't think that's something we should count on. As always, we will do a projection of the yield on cost 10 years out. This is assuming you were to lump sum once and not reinvest back. A simple yield on cost using the CAGR numbers from before. Let's go for a low 2.6%. We get a 10-year yield on cost of 5.95%. A modest 4%. We get a yield on cost of 6.9%. And instead of 10%, let's use a more conservative number. Let's go for 6%. A yield on cost of 8.51%. With the dividend stats in the rearview mirror, let's do the valuation. Why do we do a valuation? So we don't overpay for an investment. We want to be able to somewhat guesstimate what kind of returns we could get over a 10-year period. We use a growth rate to project the dividend growth 10 years forward. A terminal multiple. This is what kind of yield investors give the investment 10 years forward. A high multiple means a low yield, so a higher price, and vice versa. We also use a discount rate. This is our required return. It is used to discount the sum value back to today, and we get a present value. The present value is what we will need to pay to meet our required return. If the asset is trading above the present value, it is overvalued, and the other way around. We use 3 scenarios: normal, best, and worst case. Finally, we will do a mixed valuation to get a fair price between all the scenarios. I've gone for a discount rate of 10% for all cases. For the normal case, I've gone with a growth of 3% for 10 years. A terminal multiple of 20, so a yield of 5% 10 years out. We land at a present value of 20.68 euros. For the best case, I've gone for 5% growth for 10 years and a terminal multiple of 25, so a yield of 4% 10 years out. We get a present value of 27.44 euros. For the worst case, I've gone with 1% growth for 10 years. This could be a massive cut 1 year, some huge growth and then stalling. Well, you get the point. A terminal multiple of 16.5, so a yield of around 6% 10 years out. We arrive at a present value of 16.16 euros. Finally, for our mixed valuation, I've gone for a probability of 60% for normal case and 20% each for the best and worst case. We land at an intrinsic value of 21.13 euros or 19.01 euros with a 10% margin of safety. So, we are pretty far off with the current price of just below 27 euros. Their lowest point during the last 5 years was in October 2023, 15.38 euros. So, anything can happen. Checking the ratios, where red is overvalued and green is undervalued. The higher we go from 1, the more overvalued it is, and the lower we go, the more undervalued it is. The only valuation that is fairly priced at 0.98 is the best case. Let's cut down on our expected returns and see how it looks. If we change the discount rate to 6%, meaning an annualized total return of 6%, only then do we see some green. The only valuation in red is the mixed valuation with a margin of safety. So, let's conclude. It's heavy into financials. This could get ugly. A lower starting yield due to high valuation, slow growth, and we haven't passed 2019's dividend. So what are my thoughts? Well, as we saw, it is pretty overvalued, and lowering our standards to a 6% return to justify buying IQQA right now isn't a good idea. The strategy with investing in the 30 highest yielding companies in the Eurozone reminds me of Global X European Super Dividend ETF. They hold 25 companies and the starting yield is around 8%. So there are better alternatives out there for a higher yield. Heck, even going for a conservative covered call ETF like JEEP for EU exposure is a better alternative in my eyes. But as always, see how this ETF fits you and your financial goals. I will say pass on this one. I will put it on my watch list, and if they go down below 21 euros, I might reconsider. So guys, that's IQQA. Do you hold it in your portfolio? Would you consider it, or just go with something like EUSD? Let me know in the comments. Thanks for tuning in. I will see you guys in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!